Let's bring in Roberto Perli, head of global policy research at Cornerstone Macro. Roberto, always great to have you on the program. Let's talk about this morning's number in context of what we heard from Jay Powell yesterday, because it seemed like it was a pretty innocuous message, basically standing by the plan that they've already outlined. How does the economic situation right now inform that, in your opinion?
Well, look, first of all, thank you for having me. The employment report today was good. This was a good thing, no doubt about it. However, if you're the Fed, you look at it with a little bit of skepticism. One thing in particular that we need to remember is that the Fed now, after Jackson Hole, cares about maximum employment, right? So, first of all, the official unemployment rate is not a maximum employment by any stretch of the imagination, but also one thing that the Fed will count is the big decline in labor force participation. Right? So those people that left the labor force did not do so voluntarily. So if you count those guys, then you get an unemployment rate closer to 10%, about 9.75%. Right? So I think from the point of view of the Fed, long story short, we shouldn't think that we are any closer this morning to a rate hike than we were last night. So I think Fed will still be very, very cautious.
So the idea here that obviously there could be a lot of improvement still. In terms of the rate of improvement, is the degree to which we're beating these expectations important, though, Roberto? Because it seems like we keep moving our expectations higher, but we keep beating them. Does that mean that the stimulus we put in the market back in the spring is still having knock-on effects that have been underestimated? Does it mean that the status of the reopening has gone quicker than expectations? The resilience of the consumer? What's the best explanation for why the pace and the resilience is so much better than what the average economists are expecting?
Yeah, so I think, look, it's first of all, it's very hard to make accurate forecasts in this environment, right? There's a ton of uncertainty, and just forecasts are subject to even much bigger errors than normal. So that's that's one thing. But look, there is no doubt, right? If you step back a few months, the economy has evolved a lot better than what people thought, or what anybody thought, I think, at the onset of COVID. So that's an unqualified good thing. There are also, the other thing to say is what they just said earlier, right? So there are some data that you can take with more confidence than others, especially the officially reported data. So again, if the Fed cares about maximum employment, it's not going to look just at the unemployment rate, just at the increase in payrolls. You want to look at the totality of the picture, and participation, if you care about maximum employment, is a big part of the picture, right? So again, I think they will be very cautious here going forward.
We're looking at the 10-year yield now. Let's talk about the bond market. You've got a really good report that your team put out about the breakdown of the 10-year Treasury yield and trying to figure out sort of some of the causes for the weakness we've seen in the bond market and the Treasury market specifically since August. It's actually been one of the more steady downtrends, steady any kind of trend in this market. That's what strikes me first, Roberto, is that it seems that there have been fluctuations in equity markets. We had a little bit of a struggle from the highs in August, and then we snapped back and rallied over this week. We've seen gold, which has been downtrending, but also kind of consolidating. Bitcoin going wild. Crude even has been, for the most part, range bound. Bonds seem to be in a trend. I mean, I'm kind of approaching this from a technical perspective, but shouldn't that mean something? That since August, we've had steadily lower highs and lower lows in the 10-year, and also after the rally on Wednesday. It's the first one to fade here. What's going on?
Yeah, so no doubt, right? So there can be trends over short or medium periods of time within longer term trend that calls for very low interest rates, right? So this is not the first time that it happens, won't be the last one. I think what's going on in broad strokes here is that if you look a little bit deeper, let's not just look at yields by themselves, let's look at what message the market is sending about growth, about expected growth, expected inflation, and so on. And so that message is not very upbeat at all, right? So the market is basically saying since COVID, since March, growth, expected growth over the next 10 years on average has declined about 45 basis points. And expected inflation, same thing, has declined about 35 basis points and is not recovering. right? So that's the important macro message. Then around that macro message, you get fluctuations, right? You get so-called term premiums or technical factors that push rates up and down, like it's happening today, for example, like it's happening since August. But if we want to see sustained increase in interest rates to level substantially higher than where we are today, we need the market to start pricing in either better average growth or better average inflation, or ideally both. And unfortunately, that's not happening at the moment.
Roberto, what's the most compelling evidence that we need an acceleration of economic recovery to sustain the trend? Because we haven't had a lot of impressive inflation points. One of the charts from your team looks at inflation, expected inflation. That hasn't changed much since August. The data's been fine, but it's not like inflation's been heating up. The stimulus talks broke down. It's like the bond market is establishing this trend without a whole lot of reason or rhyme.
Yeah, that's right? So, and again, there can be shorter-term trends that have been in the past. It's not surprising; it happens all the time. But the broader picture here is even bigger than COVID, right? So, if you look at interest rates, they have declined for the past 20, 30 years, or even more, even longer, right? Why has that happened? Because inflation has gone down systematically, and growth is not what it used to be, right? So we're not growing 4% like we did 20, 30 years ago. We're growing, even before COVID, we're growing about 2%, 2.25% for the past 10 years, right? So it's this structural slowdown in the economy. I don't want to call it secular stagnation because we're not stagnating, right? But it's a slowdown. And so if we are facing that situation, and if we're not seeing any prospect, like the market's not seeing any prospects for improvement going forward, then it's really hard to envision a sustained increase in interest rate. It's just not going to happen. Just to put it in an even clearer way, what's going on here is the same thing, the same process that's been going on in Japan and now in Europe for a number of years. Rates here are still higher than they are in those countries because our inflation expectations are still better. So that's a very good thing. But that's the process, right? The structural forces that hold growth and inflation down, demographics, lower potential growth, inequality, and so on, are holding interest rates down. And unless policy changes in a fundamental way, there is not much that can be done.
Roberto, the actual versus fair value, I think, is an interesting concept when you look at treasuries and break it down by the term structure, which your team has. You've got a chart that looks at where we are for this portion of the yield and what it should be. So correct me if I'm wrong, it seems like your view right now is that this move higher in yields is not necessarily representative of the trends that should be still kind of pulling like gravity kind of on yield overall. Walk me through what this chart means and how you assess what a fair value should be. I mean, how do we know what that fair value should be?
Well, knowing fair value is it's a difficult exercise, and thanks to my colleague Benson Durham, we can actually provide a pretty, I think, sensible measure of where fair value should be. So we look at literally millions of models because we don't know which one the true model, the best model is. We look at a lot of them, and then we take a weighted average, and that weighted average these days says that a fair value for, say, the 10-year rate is about 20 basis points lower than where we are today. So it's not an enormous discrepancy, but still a substantial one given the low level of interest rates. And so this is given the expectations for growth, inflation, budget deficit, and everything else that we have today. Now, obviously, if those expectations change, then we can expect fair value to go higher or lower. But at the moment, yes, I think the interest rate at the long end of the curve, according to our methodology, are a little bit too high. So we would expect them to come down slowly over time and the curve to flatten.
Roberto, here's the thing that still always nags in the back of my mind when we talk bonds and treasuries, is that it seems our construction of the fair value and the trends you described, the sort of Japanification, demographics, and the deflationary impulses that should keep yields lower, that it still seems to be something that looks at kind of a fundamental reason for dividing yields. But then we had a period in 2019, which hasn't happened a lot, where we had inflation climbing and we had an economy that was stable, yet we cut interest rates and bonds surged. The price of the bonds moved on a backdrop that, correct me if I'm wrong, but wouldn't generally seem like an environment in which bonds would be surging. How has that affected our ability to take some of these traditional fundamental measurements when it seems we went far away from those fundamentals for a pretty extensive period of time?
I'm not sure that that's right? So I would think that even back in 2019, 2018, the long end of the curve behaved pretty much according to fundamentals, give or take a few basis points, and again, consistent with the quote-unquote Japanification of the U.S. economy. So remember, the 10-year rate it doesn't care just about what happens over the next month or the next quarter or the next year. Like it's a 10-year, has a 10-year horizon, and so the market has been thinking correctly so far that the outlook for growth and inflation and everything else is not going to be that much better than it was in the past, and actually, if anything, it's going to get worse. And so that's why we saw this increase in bond prices or decrease in bond yields, even at times where you wouldn't suspect that to happen, given the short-term horizon, right?
So we went from a 2.7 yield down to a 1.4 at the lows, even as inflation CPIs were creeping up during that period. So is the point then that CPI and inflation shouldn't be attached to yields? Because it certainly wasn't for much of 2019.
Yeah, well, they should, certainly, right? But what matters is the expectations for the future. It's not what inflation is doing today, right? Okay. So that's what the market is trying to look at. And the market is telling us, yes, this month, this quarter, next month, inflation is going to go up. It's great. But we still think over the next 10 years, it's not going to go many places. If anything, it's going to stay lower. So that's why we're seeing low fair values, low level of actual interest rates. Even if you're even leaving aside fair value, right, we're still about 80 basis points. So that's very low.
Okay, and so just to confirm, as we kind of wrap back here to the big point about right now is, in your team's view, the move that we've seen in yields up to 85 bips roughly over the last couple months, is it going too fast? It seems like that's what you're implying here, that what we've seen is something that is not lining up to the fundamentals we should expect.
Yes, I think that's correct. Again, The discrepancy is not enormous. We're talking about 20 basis points or so, but yes, the implication is given our estimate of fair value, we would expect bond prices to rise, bond yields to come down, maybe slowly, maybe not a lot, but we would expect that to happen and the curve to flatten going forward, for sure.
All right, Roberto, like it and like the call. Let's continue the conversation. Roberto Perli, great to have you back.
Thank you.
Thank you. Roberto is the head of global policy research at Cornerstone Macro.